Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Corey. Corey, have any quick news to share with the audience before we go into our headlines?
That I did have the unique opportunity last weekend to host an event here in our office for a client and a philanthropic organization that she's a part of. They were doing a debutante ball etiquette fair is what was hosted here in the office. It was actually really interesting to hear as they talked about networking, conversations, etiquette at the table, thank you notes, etc. So it was a lot of fun to see the office space used for that, to be able to support a client and something that she cares strongly about, and enjoy those unique opportunities.
Yeah, that's awesome. Yeah, I'm glad we were able to share our space over a weekend, and I'm sure we got to meet some really cool people for doing that.
Yep.
Great. All right, let's kick us off here. I'll start here with headline number one is sell your loser stocks and other year-end tax moves to consider. Corey, we're already into November and December is going to fly by. So I wanted to share some key takeaways from this article. And number one is don't procrastinate. Tax loss harvest, watch for mutual fund distributions, donate, and there's this little known teacher credit of $300 that you may be able to deduct even if you don't itemize your taxes. So Corey, do you have any thoughts on some of these quick tips from the article?
Yes, the don't procrastinate. I'm glad that you said that first, Jake, because you are correct about this time of year and how quickly it can fly by. This is the time for tax planning, not after the turn of the year in a new tax year. That will be the time for next year's tax planning. So I do think that's a great takeaway. I think the items that they've highlighted here, the mutual fund distribution.
Yeah, let me go through some of those items that they highlighted. So you're right, the don't procrastinate, but tax loss harvesting, just to define that quickly, that would be selling any loser stocks, like the article implies, in a taxable account. Now you have to wait 30 days. It's called the wash sale rule, but it's very clear here. Don't worry about this if you have an IRA, 401k, or Roth IRA. It doesn't apply. This would be in a taxable account. I think you're going to talk about mutual fund distributions. We don't do mutual funds at Falcon Wealth Advisors, so it doesn't really pertain. If you're in mutual funds in a taxable account, be afraid. I don't think that's a good idea, because you can have some large capital gain distributions, and if you're not on top of it, you could have to pay a lot of taxes. Donating to charity, obviously you want to make sure that your charitable goals are aligned in your financial plan properly. This teacher credit's pretty cool, Corey. I think you've got to spend it on school supplies or something for your homeroom, but you may be able to deduct that. You certainly want to run that by your CPA before trying to deduct that on your taxes. All right, I wanted to go through those. Did you have any other color or commentary you wanted to bring into that?
No, there's actually an article on one of these items that I'm going to talk through further here in a little bit, Jake. So I will save it for then.
All right, let's kick us off with our next headline then.
All right, the next one, make these moves to max out your benefits by the end of the year. This sounds a lot like, Jake, the article you just covered, but what's interesting is that these were all different. So both of these articles were about year-end moves, but I think they're all important. This one came from Barron's, and the big takeaways were adjusting 401k contributions, reviewing tax withholdings, and if you have FSA dollars, flexible spending account dollars, to spend those down, because typically those are not dollars that will carry over from year to year.
I love it. Great minds think alike here, Corey. We were both thinking about year-end stuff. These articles were out there. So that's really good. Max out that 401k if you can, reviewing your withholdings, and then check your flex spending account. I like it.
Yep.
All right, I got one actually from a listener. So thank you to whomever suggested we talk about this one. But this one is, never mind the 1%. Mini-millionaires are where wealth is growing fastest. My key takeaway is, finally, Corey, an article that showed some moves in the right direction. I don't know if you knew this or not, but for the first time, the average net worth of American families topped $1 million. And that's up 42%.
Wow.
Since 2019, which was 749,000. Even after inflation The real average wealth was up 23%, according to the Fed Survey of Consumer Finances. That's conducted every 3 years. Also, while the level of median wealth was much lower than the average, it actually rose more than the average between 2019 and 2022 by 37%, adjusted for inflation to 193,000. So what that means, Corey, is that inequality actually narrowed. It shrunk. Because you hear about this wealth gap and the rich are getting richer and the poor are getting poorer. But that's why I said finally some good news, and that gap has shrunk. And for the first time ever, the average net worth of American is $1 million. What are your thoughts on that?
That seems really high for the average net worth. I think it's great. I think it's a good thing that.
Well, it's skewed, right? It's almost like a barbell, because you got to think, you got the Warren Buffetts, the Elon Musks, and
good
blah,
point.
blah, blah. So I don't want you thinking all your neighbors are millionaires necessarily.
Sure.
But it is good. I mean, up 42% in 3 years or 4 years, I guess, is a lot. So
yeah, and maybe that median
that's
wealth
22 anyways, but
that you pointed out is a little bit more pertinent.
Yeah. Good. What's next?
What I have next here is a chart. Got it earlier in the show here for us, Jake. This is a good one, though. This was really just highlighting earnings season. This is from Strategic Research Partners. So the Q3 earnings season has been better than expected and is coming to a close. I have a chart here that we can display up on the screen, but this is highlighted that 90% completion of earnings is where we're at now. So most companies have reported their last quarter earnings. The growth expected has been well ahead of the estimate from even back in October, and even going all the way back to the first of the year. The bigger point here being that corporate earnings have continued to demonstrate strength that, frankly, I just don't, it certainly seems like there's a lot of forecasts that didn't expect that or didn't project that out. And at the end of the day, as we talk about often here on the show and client conversations, earnings are a crucial component of long-term growth in the market. And I very much think that it's a positive to see that the growth is continuing to come in ahead of estimates, even what was estimated back in January.
That's good, Corey. Yeah, we've had some good news from inflation that's also caused this rally, but I love it. I love to see earnings beating on the upside, and that also could typically cause the market to rally. And ultimately, like you said, long-term, it's about earnings growth.
Yep.
I don't love the chart. I think there's a lot of words in it and everything, but I like to see the green boxes. So we'll let you slide this week.
All right. Until next week.
All right. Americans can stick more cash in their 401ks next year, thanks to inflation, Corey. So I told you inflation's a good thing. So what this article says is that most workers will be able to put up to $23,000 into their 401ks and similar workplace retirement plans in 2024. And that's up $500 from this year. The limit on contributions to individual retirement accounts or IRAs will also increase by $500, climbing to $7,000 in 2024. And people 50 and older, Corey, can make an additional catch-up contribution, and that's still $1,000 and $7,500 respectively. So $1,000 more in your IRA and $7,500 more in your 401k. They're the same for Roth and pre-tax 401k. The higher cap for 401k contributions will mostly benefit the small slice of workers who set aside the legal maximum. I didn't know this, Corey. I don't think before reading the article. In 2022, 15% of people enrolled in 401k accounts administered by Vanguard saved the maximum amount. So that's crazy. Only 15% are really taking full advantage. Also, got more for you. Some older Americans will also be able to get larger tax benefits from a charitable giving strategy. For the first time, the IRS made an inflation adjustment under a law enacted last year that will increase the benefits of a popular tax planning technique. So starting in 2024, Corey, IRA holders will be able to send $105,000 to a charity and have it count towards their required minimum distributions. And that's up from $100,000 that they can do now. Corey, share your thoughts with me. What's your opinion or your point of view here?
My opinion is it's a good thing that people can save more money in their 401k accounts and their retirement accounts, because I do think that as things have changed over the years, the more avenues there are for people to save dollars for their own retirement, the better. And as those, thresholds have moved higher, I think that's a positive too. And lastly, the point that you made about the qualified charitable donations in regards to distributions from an IRA, I think that is a great tax planning strategy for those that are charitably inclined, that we have a lot of conversations about with clients. And please don't misconstrue anything that we're talking about here as investment advice. But I think that specific strategy is something that makes sense for a lot of people.
Yeah,
or should at least be evaluated.
Yeah, I agree. And again, it's good that the rates are going up. I'm disappointed to see, now again, this is only from Vanguard, so you don't got Charles Schwab or Fidelity, some of these other custodians out there, but only 15%. Does that feel small to you?
If I would have guessed before you told me that, that is probably a little bit lower than I would have expected, but pretty much in line. I would not have expected it to be over 20.
Really? And I don't know this number, but I would guess of all of our clients, about half of our clients are still working. So we've got 300 or 400 clients that are still working. In my meetings, at least, Corey, I would say half of those max out that 401k. So maybe it's because they have a wealth advisor and they can afford that to do that. Because again, we're talking about probably the typical American who doesn't have a wealth advisor necessarily. I just would expect to see that closer to 30 or 40 or even 50%. So I think that, again, bodes well for our show, is that, we're here to enhance financial literacy. So a big misconception that I see in 401k plans with people that aren't maxing it out is that they say, well, Corey, I'm putting in 6% and my company matches 6%. So yeah, I'm maxing it out. That doesn't mean you're maxing it out. If you make $100,000 and you're only putting in 6%, how much are you putting in, Corey?
$6,000.
$6,000. And this article is saying you actually can put up to $23,000. So you've got a long ways to go before you're actually maxing it out. So again, I think that's just an area for people to improve their literacy and to hopefully save more if they can afford it.
That's very good. All right. Next, so speaking of 401ks, the next article is from the Wall Street Journal. Your 401k is falling behind. Here's what you should do. There you go. The article here talked about how most people keep their 401k account on autopilot by investing in a diversified portfolio of stocks and bonds. But faith in this approach has been shaken by 3 years of losses in the broad bond market. And it's being further shaken now with yields on government bonds around 5%. Some people are thinking of taking money out of stocks and putting it into bonds, given the fact that interest rates have moved a lot higher. I don't know about you, Jake. I've certainly had conversations with clients about just that. But the suggestions from the article, I thought these were interesting. What they pointed out was there's 3 suggestions. 1, stick with target date funds. 2, don't give up on bonds. And 3, consider TIPS or Treasury inflation protected securities. I was surprised to read those 3 suggestions in this context of the article. But what are your thoughts on that, Jake?
I think it's reckless to put that in an article. Target date funds might not be the worst thing for the do-it-yourselfer, but I don't think that people should be going at this alone. Again, I think it's reckless to try to give investment advice in a media outlet. I think it needs to be a custom approach. So target date funds aren't the worst thing. Obviously, don't give up on bonds. Tips are, what are they? What's the Treasury inflation protection securities? We don't do a lot of tips. I don't know if you want to do that in your 401k. Maybe there's some tax deferred benefits from doing that. So my point is, my perspective, Corey, is don't take advice from an article you read. Go meet with your wealth advisor, set up an allocation that aligns with your financial plan, and don't just go do what your neighbor or what the media tells you to do. Is my
yes,
perspective.
And which was highlighted well, I think, in this article, that establishing the strategy and the plan and sticking to the plan is oftentimes the right approach to take, which I do think that they highlighted well in this article, and also talked about there's a few months or a year or even 2 years where the investment strategy doesn't feel like it's working. That does not mean that you should blow everything up and try something completely different, because that should be part of the expectation.
Yeah. Excellent. All right, my next one here. People no longer know how much to tip. Shame on you, Corey, for tipping on cash. People don't pay taxes on that when you do that. My question, though, for you is, do tipping prompts, you know what I'm talking about? When you go to like the deli or somewhere and you've got a tipping prompt where they'll say 10%, 15%, or 20%, does that make you tip more, less, or the same?
The same.
And what is your standard tip? I'll call you out.
Typically 20%.
So you just go max.
Well, I've noticed more of those prompts now say 15, 20, and 25%.
And you stick with 20?
Yeah. Yeah.
Okay.
I guess what I'm trying to say is the prompt hasn't really influenced my behavior.
See, the prompt has influenced mine, believe it or not. I just go to the max every time. Pretty much every time, I think. Most times. I can't say every time because I don't know that. But most times, I just go to the right. I see that there's a chronological order, and I just hit the max tip every time because I don't know. I just the kind of guy I am now. But if I was writing it on a receipt, like the old school way, I would put 20% usually, like you're doing. So it's interesting that you stayed firm, and it has influenced me. How about this one, Corey? How do you feel about no tipping in Europe? You've been to Europe.
I think that is their tradition and their standard, and that's okay with me if it's okay with them.
So when you were in Europe, you didn't tip?
I did.
You did tip or didn't?
I did tip, even though I know that tipping in Europe is not customary the way that it is here.
Wait a minute. So you just said that's fine with them, it's fine with you, but it's not fine with you because you tipped.
Yeah, well, I've been to Europe once. I don't know the next time that I'm going to go, and I'm happy to tip the people that make it a great experience while I'm there, whether or not other people do.
So you're saying you don't acknowledge their culture?
I guess so.
Interesting. Yeah.
They would rather, and maybe they'd rather not get a tip, but that seems odd to me.
I know. That's what's so strange. I went to Rachel and I stumbled across this very nice restaurant in Paris near the Eiffel Tower for lunch. And this thing, I don't know if it had a Michelin star or what, Corey, but it was nice, right? And the waiter went all out for us. And it was expensive, not like crazy, but it was more than I wanted to pay for lunch probably. But I felt inclined to tip him, and he looked at me like I was an idiot.
Really?
Yes, he actually looked
interesting.
He looked embarrassed that I was giving him money, almost like I was like demeaning him, even though I was trying to say thank you for making this an enjoyable lunch, and he was almost like insulted.
Interesting.
Yeah.
Well, maybe I'm sure though, I'm confident, in fact, that it is different from country to country and place to place in Europe, because I do know that Greece, which is where, Cassie and I have been, it is a bit different there. And not a single person looked at me like I was crazy when I wanted to give him a tip. They're like, I'll take it.
I don't know. I don't know. Maybe you're right. I don't think you're right. I think you're not supposed to tip in Europe. Anyways, let's move on.
All right, that's what you think.
What's our last one?
Our last one is to bring us home here. It's going to tie us back into the first one. Ouch. Some fund investors will face a big tax bill. This talks specifically, this article in Barron's, about capital gain distributions from mutual funds inside of taxable accounts that you highlighted earlier in the show, Jake. So it's capital gains distribution season, is what Barron says, and big tax bills are on the way for some fund investors. And I do think it's important and helpful for people to understand that a money manager's trading throughout the year causes short-term and long-term capital gains and losses that get passed along to the shareholders. Usually happens about this time of year. And what I found the most interesting about this is that fund outflows, or funds with the highest outflows where people are pulling money out of the funds, forces the managers to sell investments and realize gains so people can take their cash out. So for the people that are still investors in the funds, they can ultimately end up getting hit with a sizable tax bill. So it's interesting to me to consider the fact that fund, inflows and really outflows from funds, regardless of what you or me, Jake, if we were a shareholder in a fund, regardless of our behavior, other people's behavior can influence my tax bill, which I just don't like.
Right.
And I think, go ahead.
Oh, that's why I think individuals using mutual funds and taxable accounts is silly. Like, again, I get it. Maybe if you're on your own, but there's other ways. There's other things you can do also. So, like you mentioned, This show's not designed to give advice, but I like that you brought it up. So again, for the individual investor, whether you have an advisor or not, if you've got mutual funds in a taxable account, you need to be aware: are there going to be capital gains distributions, and are you prepared to pay that taxes? And what does that do to eat into your investment returns? So, very good, very good. And with our show, Corey, I want to start, making sure that we have some, actions or, actions to encourage people to make. So again, I think today's theme is really about don't sleep on the holidays here, and let's look at some tax planning for you. Maybe it's time to donate to charity, take a look at your deductions, realize some tax losses, maximize your 401k, whatever that may be. But that's the key action here that I want everybody to take that's watching the show or listening, is that make an appointment with your wealth advisor. Say, hey, I want to do some tax planning. I want to review my financial plan, whatever that is. Let's do it now and not wait till January. Don't sleep on this. And let's see if we can do some things to ultimately enhance your financial plan. I think that's really the key action that I want people to take away from today's show. Do you have anything before we wrap up?
I agree with that completely. We're at that point in the year, and I made a joke about this earlier today, Jake, when we were talking about something completely different, about how I've noticed that I've started to get, from a few people here and there, like, oh, well, busy with the holidays and year end and this and that as we get into January. I'm like, I understand the holiday season, spending time with family, friends, et cetera. I think that's important for people to do, but I think that to use that as a reason to not do any proactive planning when there's still 45 days left in the year seems silly.
Right. They use it. Yeah. And maybe that's why we have jobs, or maybe we're dorky finance guys, but it's like, come on, like if you could save yourself thousands of dollars, if I could tell you, I'm going to make you thousands of dollars if you just meet with me, that'd be pretty cool. It's the same thing with tax. We can save you potentially. Again, there's no guarantees, but maybe we can save you thousands of dollars if you just sit down and look at your taxes and do some tax planning. We're not CPAs. We're not sitting here going to file your taxes, but maybe we can do some things. Maybe put some more money in your 401k. Maybe give some money to charity, whatever that may be. And maybe that'll help your overall tax planning situation. So good.
And at the very least, you can at least get a better idea of what to expect come tax time next year when you file your return.
Right.
Instead of it just being a surprise.
Right. Very good, Corey. All right, we're going to wrap up today's show. Thank you all for tuning in. As always, please like, share our content. Our subscriber count, Corey, on YouTube is over 600.
Saw that.
It's growing very quickly. There's only a couple months ago that we were still in the 400s. So thank you all for who have recently subscribed. Thank you to all of our long-term subscribers. Again, please like and share our content. We're doing this ultimately to enhance financial literacy, and we hope all of you out there have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.